right, got people coming in. We're going to start 2 minutes into it. Hey, Paul, I see you there. Paul's our CEO coach. Hey, as you come in, if you would put the city you're in, the industry, your company name, whatever you want to put in, so that our panelists, our distinguished panelists, can kind of direct the call more about what you're looking for. And Randy, I said I wasn't going to jump in, but I just did.
That's fine, Kirk. You got us rolling. So let's proceed here. So hello, everyone. We're going to have a great webinar today about due diligence questions, and we've got answers. So think of this as the do's and don'ts of diligence that it's required. So being due diligent ready is really will speed up your transaction as well as help to maximize the valuation of the company, which is obviously super important. So just to introduce myself, my name is Randy Bambro. I'm a Silicon Valley experienced growth CFO at Foresight CFO. I've helped a number of companies go public, raised hundreds of millions of dollars in capital, and have done a number of acquisitions over the years. So I've been through the due diligence process time and time again. Also in the past, I taught an MBA class or classes at Santa Clara University in both entrepreneurial finance and business valuations. So at Foresight, we provide growth and CFO services to help CEOs and CPA firms and partners to obliterate, and we use that word very proudly, the obstacles that stop growth from occurring. So I would now like to introduce you to another Foresight team member, Jose Villarino, and he'll tell you about his background.
Yeah, hi, everybody. First of all, thanks a lot for taking the time for joining us this afternoon. And our goal here in the next 45 minutes is to not only answer your questions, but maybe create some more questions in your head. And so we can pinpoint and we can fine tune and hone what your message is going to look like and avoid some of the basic mistakes people make. But like Randy, my background's also California in technology. I spent a lot of time in Silicon Valley, kind of grew up there professionally. Then I've spent time in private equity, specifically around airlines and airline assets there. But really for the last 10 years, what I get really excited about is working with small, mid-sized companies that are ready to make that next leap, that next move, that next evolution. And this is what I'm doing here at Foresight, is working with these companies, getting them ready to for that next evolution where they want to be. And this, the goal of this, like I said, is all ties into the goal of this particular webinar about what do you need to do now to be prepared if and when, more specifically, someone comes knocking and they're interested in that baby you've been cultivating and growing yourself. Thanks, Randy.
Yeah, thank you, Jose. So with that, we're going to go over the agenda really quickly. So we're going to have our two esteemed panelists spend about 7 minutes each talking about their background, their firm, and some experience they've had on both good due diligence and not so good due diligence, we'll say. So at this point, I'm going to turn it over to Steve Gaynor, who's with Brighthorn, and after Steve's done, then Abe Thomas, who's with Piper Sandler, will take over. And then after that, then we'll open it up to questions. So feel free to start putting questions into the chat room as you see fit. Steve, take it away.
Well, Randy, I guess the first thing I want to ask is, why do you think either Abe or I have ever been involved in a bad due diligence? I mean, you must be kidding me.
Yes. Yeah. Well,
okay.
I've seen you in action, both of you. So
there you go. There you go. Can you see my screen?
Yes.
Okay. So just briefly, my own background. I'm a graduate of both Harvard Law and business schools. I'm a member of the bar in New York. I went through a program where you get both degrees simultaneously. And then I went to Wall Street. I was on Wall Street for 10 years. I worked with Skadden Arps, which is many consider the premier M&A law firm in the US, well, really global these days. And I was also an investment banker with Elif Rothschild in their New York office. And then I was recruited to join AirTouch, which was a spin out from Pacific Telesis. So I went to San Francisco and I basically did international deal making, which led to our acquisition by Vodafone. That was a $62 billion deal. And so that was another, well, I should stop counting the years. And then I became a boutique investment banker in Silicon Valley. And then we expanded internationally as well too. And with MSG, and then today I am a partner at Brighthorn Partners, which is a very well respected and very successful middle market investment banking firm. So just a little more on Brighthorn. It's, in addition to being an investment banker, it's a broker dealer. So it actually deals in securities as well. We're focused on lower middle market, sell side M&A and capital raises. And we're experienced in many sectors, many industries, tech, financial services, healthcare. All the partners have experience in each of those industries. Now to the fun part, the stories, right? Let's see, we were asked to put together our best due diligence experience and our worst due diligence experience. Our best my most interesting due diligence experience really was a very recent one where we had a client who, SaaS company, selling services, and they gave us their numbers, but we decided before taking the company to market to do our own math, look at the numbers, dig in deep, and we found that they weren't doing their calculations correctly and that their business was not as profitable as they thought. And we identified which clients were causing issues, and we were able to make changes before we took the company to market. So it's a great example of why, for example, you want foresight involved, or why you would want us involved, to really discover any problems, because if a buyer discovered those problems during due diligence, the buyer would simply walk away. So that was the best, and that was a recent example. Now, the worst due diligence ever really was in the newspapers the past few weeks. Theranos. Say that for the Q&A. We weren't involved in Theranos, but that's a great story. And I would say, personally speaking, the worst due diligence from my side would be when I was on the buy side, not the sell side, but the buy side. Worked on a deal for months, got the deal, then went into due diligence and discovered problems. And that typically happened to me overseas, not in the US. And I'll tell you just one example, where in Mexico, as we were buying a very large telecom system, we discovered issues on their balance sheet, essentially a mismatch on their balance sheet. If the peso was devalued, would create a loss. We had to walk away from the deal. I cried. I had worked in that deal for 9 months when we walked away. And Bell Atlantic picked up that deal. And a few months later, they had a $300 million write-down from that very issue. So it turned out well for us, but it was a pretty horrible story for them. So let me turn it over to Abe now. Thanks very much.
Hey, thanks, Steve, and thanks, Randy and Jose and Kirk, for hosting. I appreciate the opportunity here to share a little bit more about our perspectives on due diligence. Let me get my little slide reel up, and I'll run through it quickly. All right, that should be up. So my name is Abraham Thomas, and I work for Piper Sandler. This is just a brief overview on Piper Sandler as a firm. We're a $2 billion publicly traded company under the ticker PIPR on the New York Stock Exchange. We're headquartered out of Minneapolis, and we've been around since the late 1900s. We like to say headquartered out of Minneapolis with all of our key management, that we've got strong Midwest values, which really sets us apart from a lot of the other banks that are either headquartered out of New York or on the coast. I think we value partnerships and the quality and caliber of the people that we work with. And that first and foremost is a rule that we have, that we want to work with the best companies and the best people. And that is part of what has made us so successful. On the top right there, you see where we specialize, which is in transactions less than $1 billion in value. If you sum up all of the transactions our firm has done over that 5-year period, we, relative to all of our comps in that space, have a dominant position. We also, on the bottom, are growing and increasing in our momentum of deals. So on the bottom left, the number of completed advisory transactions, which we think is important to our clients, given it is our currency with the best and most respected investors. The more we show them, the more that we have touch points with them, the more we understand what are the things they're looking for in due diligence, what are the things that are cropping up lately, and what are the assets that we think are high quality and help frame our clients in the mass of volume and deal volume that these investors look at frequently. And on the bottom right there is just our revenue growth, publicly disclosed, of what our advisory practice does. And relative to our peers, we've grown 5x versus our comparable set, at kind of doubling over that same time period. And then over on the far right are the large multi-billion-dollar bulge bracket banks. So we're proud of what we accomplish in the space we play in, which is really the sub-billion-dollar advisory practice. So where I focus, a little bit more about me on that top right, those are all of my clients specifically. I sit in the consumer team within Piper. Piper has teams that cover industrials, technology, healthcare, financial services. I sit with our consumer team, and within our consumer team, we split the world up into a handful of different sectors as well. And where I specialize is in this health and wellness category of services, which has included a lot of great fitness brands that I'm sure some of you have driven by and hopefully are members of, or the Orange Theories, Anytime Fitnesses, Planet Fitnesses, Core Powers, Crunches of the world. We're branching out and extending beyond just fitness into the continuum of care. So a couple of transactions we've done just in these past 12 months have been with Restore Hyper Wellness, which is a cryotherapy company who focuses on recovery and pain management. Great IV drips to help you get back on your feet. And then on the far right, we also have personal care services. So that top brand of me is the leader in Botox and dermal filler injectables, Dry Bar, which is the leading women's hair blowout concept, Heyday, which is the leading facials concept. So these are the kinds of brands, all sector and category leaders, and that's important to us. And we really pride ourselves in banking high growth category leaders within the space. The rest of this page, I just wanted to highlight, as these companies come to us and ask for advice and advisory through this path to partnership, and or whether it's bringing in growth capital or bringing in debt or bringing in a new partner for the first time, or selling and having a first, second, or third liquidity event. These are the principles of preparation that I wanted to highlight for you all. First, all great investors will trust great management teams and the things they tell them about their business, but expect to verify those things. And before you go and start your process, you want to be in a position of strength. And a phrase I live by is, when the time for performance has come, when you're about to go market your company, the time for preparation has passed. You go to market and it's go time. And your preparation is shown in the process execution that we will help you do beforehand. And groups like Foresight will help you make sure that you go with the right army into the battle of meeting investors, meeting strategic buyers, and having the right information at your fingertips to, again, go fast and create the kind of momentum that gets deals done in a timely manner. Something we found in our practice is that you first go slow to go fast. The preparation you do up front before you go and launch market is very critical. Another mantra we live by is that time kills all deals. If you have hiccups where people are asking for confirmatory items and it takes a long time to produce, then that time and delay never does a process good. The other thing that preparation does is it helps you understand the business in a way that you won't get surprised, whether it's projecting your business or making sure that you've got all of your legal documents in order. The upfront preparation will help you make sure that all that's in order. And I'll have a couple examples here to round out my time. And last, a great process and the preparation you do will create this idea of equality of information. And I'll start there with my first example. In one of our transactions over the last 12 months, we had one of our clients approach us and say, hey, we've had an inbound interest at, call it $200 million. We think that's a great value. It's a huge multiple off of our trailing EBITDA. And we just want to do a market check with the most likely buyers that are interested in this space. What that preemptive offer buyer had done is a great consumer survey work of the industry and identified our client as one of the top net promoter scores in the category. So they came and gave a great offer. What that had, though, was asymmetric information. They knew things about our business which were to the positive, which which management had not dug into yet. Had a tiger by the tail. We're growing incredibly quickly. What we did is we went slow to go fast. We took a month and a half and sat on the preemptive offer, made sure we understand the customer lifetime value, how customers were coming in, spending, how long they were staying, what it cost us to acquire them, so that we could understand the same kind of metrics and then share with multiple other buyers the same kind of quality information so that you could have multiple bids on equal footing so that you had a competitive process. And ultimately what happened is that preemptive bidder did win the day, but paid 30% more than what their preemptive offer was. And we had several other buyers that were willing to pay, within a marginal difference of what that value was. On the bottom here, I just want to highlight a few things we run into for our pitfalls. Like Steve had mentioned, if you have unclear unit level economics in your business and you can't clearly explain the growth engine and power of your model, that's just a huge problem to the process. One example I've got here is we had think of an active sports retailer, somebody like a Billabong type brand. It wasn't Billabong, but somebody like them. They had kind of two sides of their business. One was their retail stores, which were flagship locations at Main and Main that were great. And we were amazed that they had great store level margins of 35+% at the store level, which in our world is compelling. And then there was this other side of their business, though, that we rushed to market before we fully understood this quote unquote warehouse wholesale side of their business. And what we came to discover through diligence, unfortunately, was they were doing intercompany transfers where the wholesaler would sell at a margin that would basically fix the margin of their retail flagships. And then they would have these once a year blowout sales through wholesale where they would be selling a bunch of negative margin product. And so you had no idea what the value of the business was because you were trying to value their retail on one side, but their wholesale was such a disaster that you had to actually combine them to understand that your margin profile was not compelling. So that was a big hiccup to that process. Another area,
So Abe, can we take a couple more minutes so we can jump into the questions here?
Oh yeah, absolutely. Yeah. So these slides will be posted later. So I'll pause right there, and then Randy, I think maybe we can hop right into the questions.
Okay. All right. Perfect. So we started with Steve on this session. We'll start with Abe on the question. So Abe, how would you describe today's market?
Yeah, so for today's market, I would say, great assets are always in any market very resilient. And in today's market, there's a lot of money on the sidelines that is eager to get put to work. So I think you've seen, most publicly in the SPAC market, the special purpose acquisition company markets and in the public market eyes, you saw that a bunch of people were trying to rush for the markets. And I think that was indicative of just how eager people were to put capital to work in the dream. I think SPACs had the benefit of marketing very forward-looking projections in the public eyes, got a lot of retailer interest. You've gotten a lot of people that have become, the retail day trading experts on the side through COVID. I'd say that on the private equity side and private capital, you've got huge pools of money that are also very eager to get to work. And so I would say, the deal environment had a hiccup in 2020. 2021 saw record banner years for advisory work and transactions. And I think we're still continuing to see robust recoveries of COVID, of concepts out of COVID, and a lot of money and capital that's interested to get put to work.
Okay, great.
Hey, Randy, let me hop in here. Steve, I've got a question for you. What are the issues or challenges you're seeing in the market today? And to a certain extent, as we're coming out, or perhaps I like to think coming out of COVID, how's that impacting the market and kind of the processes you're seeing to get deals done?
Well, I mean, if we were to characterize today's markets, and it depends on what you mean by market. If you look at the public markets, the trading markets, they're volatile right now. And there's a lot of uncertainty about what the Fed is going to do and how long we'll be under, still this pandemic and the effects there, and the geopolitical situations around the world, whether that's Russia and Ukraine, or the situation with China, et cetera. So that's a backdrop, and so we're at a market that's in transition. We were in equilibrium for the past few years. Now we're transitioning to something else, and so that creates uncertainty about what that something else is. And so with that backdrop of uncertainty, nevertheless, and I agree with Abe's comments, if you're talking about the M&A market, and I think that his comments were very, specific to the M&A market, it's still very, very strong for the many reasons that he mentioned. It was, there's a lot of capital on the sidelines. And even though the Fed is currently raising interest rates, they are still historically
Very low.
And so that will continue to drive deals. We're also seeing earnings still from companies fairly strong. They're having issues, of course, with supply chain, labor, finding labor, et cetera. We're finding that, but earnings seem for many sectors seem to have been coming in pretty well. So that is propping up the market. But nevertheless, there is this backdrop of uncertainty. Many of our clients are frankly rushing to the exits now and say, look, it's a great environment for M&A now. There's a lot of capital. I'm a little concerned about a lot of this uncertainty. Not sure where it's going to be next year or 2 years from now. And so that's driving a lot of our clients.
Okay, great. Yeah, Abe, so when people are thinking about due diligence, right, and all the steps that are involved in it and when to start, what do you suggest? When's the earliest you should start thinking about getting due diligence writing materials inside of a company?
Yeah, so I think you should always have good record keeping and keep all of your information in working order as soon as possible, right? So the answer is the due diligence process begins today, no matter when you're going to sell, because you don't want to be scrambling, for example, for key IP. One other example of a deal I was on was when one of our clients didn't realize that they didn't own one of their trademarks until we were about to close. And luckily the lawyer was neighbors with the guy that did own it, which was just a bizarre circumstance. But that's the kind of thing where all of your legal documentation of how your company works and the contracts that govern the key components of your business should work today. And your understanding of your unit level economics, people like you helping companies early on, or having teams in-house that understand the unit level economics and be able to understand the KPIs of a business early, that's critical.
If I might say something too, because sometimes when people ask, how early do I have to begin my due diligence? Sometimes what they're really asking is, how do I maximize my value in the due diligence, right? And of course, the answer to that is you should get to work on that. Well, obviously, you want to always be able to maximize your value. But if you're looking toward a transaction and you want to take certain actions to maximize your value, and there's certain actions you can take. You can reduce your working capital, for example. You can reduce maybe some of your debt or something, depending, or drop the cost or something, and then increase your earnings. The ideal time would be to have a relationship with a banker, or again, you gentlemen have these skills as well too at Foresight, which is to say, if you want to maximize your value, then you better think about getting started 2 years in advance. And so that you've got a 2-year runway, 2 years of history that you can present where you have increased your earnings, you have taken steps to strengthen the company, et cetera, and maximize your value that way. And again, I bring this up now because it's not really on topic, but I think sometimes people ask that, or really kind of asking that question. They're asking, how do I come out of the due diligence with flying colors, including a high value?
Yeah. And tying to kind of Abe's earlier comments about being able to explain your business, as you start that due diligence, start thinking ahead, right? And you're putting your numbers together, and if you're able to put together a narrative that's consistent and confident about how you've been improving the business, why and how you grew the top line, why and how you reduced expenses, that all goes towards helping that banker, that person who's going to get you through that transaction.
Yeah.
Um,
Hey, just to cut in here, we got 2 messages. Josh and Roxanna. Just kind of curious. Like Josh has an interesting business, physical therapy, sports rehab. So, Josh, are you looking to raise money, or are you looking to buy other businesses like yours to grow strategically, or are you looking to sell? And Roxanna, the same question for you. She has a Chicago construction company. What are you guys looking for? Are you looking to raise money? You're looking to exit, sell your business, or you're looking to acquire other businesses? But got interesting, diversity of industries here. But if you can drop that into the chat box, I'll bring it out to the group. So Jose, back to you.
I kind of finished my thought right there. Was just tying it together. The due diligence is not just about getting the numbers together. It's about really putting together the narrative, understanding your business, and the numbers support that, right? So when you do sit down with someone like a Foresight to help you get that package together, and you bring on board an Abe or a Steve, they can pick up that baton and start, and they'll have something to work with right away. It goes back to the time to market and being confident, consistent with your story.
Yeah, and it's all about sort of creating this corporate infrastructure, because if you have this infrastructure in place, the due diligence is going to naturally fall out of that.
Yeah.
So when I talk to people about when to do due diligence, I say, when you start the company, you should start thinking about the due diligence process then. Because of what I've seen is certain people, I mean, there's a friend of mine who's an auditor, and he says he's never had one person ever regret getting an audit done too soon. It's always just the opposite.
Yeah.
But that's an interesting point, if I can chime in there. And I'll let Steve and Abe comment on this, obviously, is you don't necessarily always need audited financials. A reviewed financial, it depends on the market and the buyer. Is that correct, guys? What's your take on it?
Yeah, well, I'll say just a couple of things. Yes, a lot of times, the companies that we work with do not have audited financials, but we do like to have some kind of third-party review. And so reviewed financials are okay, but you should then expect that the buyer is going to do a more heavy due diligence. And so we see the buyer bring in essentially a small audit team to spend a few days in the company and go through it to make sure and verify the numbers. I also just briefly wanted to make a comment on Randy's mentioning of infrastructure, which is, let's remember that a buyer is making the acquisition on the expectation that they're going to get a return from it. And a return, typically, I can either come, 2 major sources, really. One, either synergies, and so that could mean reduction in costs and duplications, et cetera. But very often in many industries, it's really about growth. And so you need to have the infrastructure in place to show in a due diligence that you can scale and that you can grow quickly, and that will drive a good due diligence and your valuation. Thank you.
Okay, great. So let's see, another question. People are curious about cost, what to expect. Let's see, Abe, you want to take that one? Then Steve, you can talk about it as well. Just sort of what expectations should be when they get into the process. Like, you've got the outside professionals like the accountants and the attorneys and all that kind of stuff. And obviously it depends on the size of the company, but just some initial thoughts.
Yeah, I'd say when we're just modeling rough transaction costs for clients, having 3 to 5% of overall transaction value go to the costs of the suppliers of advisory work is probably a good ballpark to start. To the point of, do you need audits? Do you need reviews? Do you need a sell side quality of earnings? My perspective there is that can be pretty industry dependent. If you're a credit card cash flowing business that's got very simple payroll, you probably don't need to do anything because the cash flows are just so apparent. If you're a company that has long lead time guarantees and long contracts and other things where GAAP estimates and management estimates really impact kind of when you recognize the earnings and you've effectively performed your duty, that gets really confusing, and that can swing $1 million EBITDA impacts. So your EBITDA, when you're applying, an 8 to 15 or more times EBITDA, every couple $1 million of found or lost money is a material impact and a surprise. And again, we want due diligence to be the most boring process and have no surprises, have it be confirmatory, and that's really the goal.
How about you, Steve? Thanks.
Yeah, and I think the 3 to 5% estimate is right on, and I would say that your money is best spent anyway before due diligence. As we've said, we don't want any surprises in due diligence. You want to be able to present the company in good shape, et cetera. So spend the money before you get into due diligence, and make sure that, as Abe says, you're going to sail through. But of course, you're still going to have the attorney costs and some accounting costs as well too. Those are the two primary ones.
Okay.
Here's a question just popped up. How important I think these books must be on cash basis. How important is it to be on an accrual basis? If you're running cash basis right now, is that an impediment? Is that an issue to getting a deal done, or the smoothness of getting a deal done? Or should you recommend everyone start thinking about moving to accrual?
Abe, you want to do that?
Yeah, my perspective is investors in my world want to understand how management manages the business. And if cash is how you manage and it's easier to understand and is the way that you're managing the business, then they want to see the financials as you are understanding them. Now, that's not to say the way you're looking at them is perfect. And I think having outside counsel advise you on some key issues is helpful, which is the whole value I think Jose, Kirk, and Randy can bring to a process where you may have just kind of a controller caliber person providing the bookkeeping, and you don't really have a financial officer. But in our world, the answer is always both. People want to understand what cash is, they want to understand what GAAP is, and they'll default to how you think about it. So, if you're a hair laser removal company and you have a lifetime guarantee, GAAP will call for you to actually defer your revenue over the expected lifetime of people coming and getting laser treatment. In reality, that business gets all cash up front, and that's how the business is managed. So in that business, cash and GAAP are wildly different, but people value it off of cash. But there are others where, in personal training, I also work in fitness, where you can sell 100-pack of personal training, get all that revenue up front, and then you have to service it and you have to pay the person that services it. So your costs and your revenue are completely misaligned. So you can't represent, oh, I'm making a ton of money, when in reality, you need to offset with the cost. So it is dependent, but unfortunately the answer in my world is both. People want to see both.
Yeah, it is. I'm definitely going to chime in on that question. It's too good to pass up. So Randy, I'm violating the protocol twice here. All right. That's
so
the
for
way.
the record, I had 3 violations in the pool for this particular webinar, so we're getting close.
So here it is. If you're running your business on cash, if your business is bigger than a shoebox, or if you want it to be bigger than a shoebox, at the very least, you are leaving money on the table. Why? Because accrual accounting, what is it? You're lining up your direct cost to that unit of revenue, back to unit economics that Abe is talking about. So if you're not doing that, if you're not lining things up, if you're not matching, the money in with the money it costs to earn that money, guaranteed you don't have the information you need, the clarity of information you need to make the best pricing, to optimize that value pricing. guarantee you don't have what you need to engineer profitability, because profit is not the same as cash. It is a different financial measurement, right? They correlate, but they're different, right? You can have profit and literally never collect the cash, and you have still have profit and no cash, right? And vice versa. So if you're on a cash basis and you are or want to be bigger than a shoebox, you're leaving. You might survive, but you are leaving money on the table. So what does that do when you want to do something strategic? Well, profitability, since valuation is determined by a multiple of your profitability, then for every dollar less that you have in profitability, you have $6, $10, $15, $20 less in value, right? So here's the caveat. It's a paradigm shift to understand accrual accounting, because it's different from cash, but it's not easy. It takes process, but your accountant can get you there. And if they can't, you don't have an accountant, right? You have a bookkeeper. So it's low cost to get there. It just takes a few cycles, 2, 3, 4, 5 months, you'll be there, right? But it's a learning process. So is that enough of a contribution on accrual versus cash?
Well done.
Yes, yeah. Thank you. How about this? This one's not really a financial issue. It's about cultural fit. So when you're going through the due diligence phase or process, what role can cultural fit? Because I've been around acquisitions where it was a disaster after we finished it because we didn't really properly assess the cultural fit. And curious, why don't we start with you, Steve, and then Abe, if you could chime in.
Sure. It's a really good question because people don't think enough about it. And I would say it's extremely important. And the reason is because you're going to be getting married to somebody for a few years at least post-acquisition. And you want to make sure that your vision for the business is the same. You want to have a lot of clarity as part of the due diligence process. What is the business plan after the acquisition? How long do you expect me to stay? What role am I going to have? And a lot of that will have to do, and in part of asking those questions is getting comfortable with the culture and working with the group, because whatever they're paying, if it runs into a hiccup later, and don't forget, a good many deals are going to have, I suspect, market are going to have earnouts and contingent consideration. Then you'd better be sure that you and the buyer share a culture or a vision, or you can actually get there. But there's a certain comfort level going forward, and that works two ways: for the buyer in assessing you, and you assessing the buyer. So it's a very important aspect of it.
Yeah, thanks. Abe, what's your experience been on that front?
Yeah, I mean, it's so dependent on the kind of transaction that you're seeking. Are you seeking kind of a growth equity minority partner? And so what's important to you is, somebody that is additive but doesn't want to be controlling. Are you trying to sell a majority of your business, but you still have a significant minority? Well, then, how are they going to lead the ship? To Steve's point, do they have the right vision? Are they going to take your rollover equity and help you triple, quadruple, quintuple your rollover, because they've got the keys to the business at that point in a majority position? Or if it's a full sale, how do you gauge, is a strategic being genuine in their research, or are they kicking the tires to just figure out what your business is all about and then have no sincere interest? That's part of the value that Steve and I ideally bring to our clients. We deal with these buyers more frequently than any given seller will, and we should be able to understand body language and cues. And we are able to tell you, hey, buyer is actually flipping around. He's coming from across the table to on your side of the table. And that's a beautiful part of the due diligence process, where they have a fiduciary duty to do their due diligence for their investors. It's not, it's not the deal maker's money. It's usually him acting on behalf of someone else. So he's got responsibilities, but there's that point where we can tell in our processes where it's starting to be much more collaborative, figuring out what's this business all about so that we can together make it grow and have it grow bigger. And that's the part we always look for when there's rollover involved in our deals.
Okay. Great. Did you have another question there, Jose?
No, I think I'm good. I think we're kind of hitting on the time limit here. So I wanted to maybe open it up, see if there's any questions out there in the audience. You can drop them into the chat box. And maybe we can just close out if there's nothing more. Yeah, I don't see anything coming up in questions.
Yeah, just to put the two bits out there, and we'll.
Oh, here we go. Hang on, David. David just chimed in. Is there a reasonable time frame for due diligence?
You want to? I'll take first step. Typically, well, reasonable depends on which side you're on, right? So the buyer wants longer, the seller wants shorter. Typically, it's at least, for a private company, it's 30 days. Is a low amount. Buyers will often ask for 60 days for a due diligence. Sometimes we split the difference and it's 45 days. And after that, it really depends on the particular situation. Obviously, the more homework the seller has done to get the company ready, and that's very obvious from the documentation, from the preparedness of the CFO, et cetera, the more comfortable the buyer will be in having a shorter due diligence because they've seen the right things up front.
Yeah, and David's saying that he's been told 90 days is rushing it.
It depends on the company. I'm assuming here we're generally talking about smaller private companies, and that's been my experience with smaller private companies.
Yeah, and David, if you want to follow up, we can get a second opinion on how big is the bread box and what's reasonable, right?
Yeah, here David just chimed in. Yeah, he says he's been told 90 days is rushing it, and I believe from your answer, David, that you're 5 million per annum in revenue. Yeah, I read that right. Thank you.
90 days for a $5 million company strikes me as a long time.
Yeah, be careful that somebody's not fishing to get free information about you.
Yeah, it's too long.
Or trying to come up with something that they can ding you on the price on.
Yeah.
Yeah.
Good point. Right?
Yeah. Or I really question whether they're ready for a transaction. They should have, a buyer truly, by the time you reach due diligence, you already have an agreement, right? There's a letter of intent. You already have an agreement, and you agree to how long a due diligence period would be. And if they're asking for 90 days or more, then I really wonder, well, why are we negotiating a deal, et cetera? Don't you have your due diligence team ready? Don't you have your lawyers ready, your accountant ready, the team from your business ready? Why? You should have them all assembled. You knew we were going to have this due diligence. So I got to wonder about that buyer.
Yeah.
Dave, it looked like you were going to say something.
Yeah, this is the value that a well-constructed process really helps hold all buyers accountable. And what I would suggest is, if they need 90 days, you should understand what are the milestones in the first week, second week, third week. And that's what we do as advisors. We really act as the friction point to make sure that people are acting in good faith. And if you're partnering with someone, you shouldn't be the one following up with them, right? You want to push your advisor to be the friction point, make sure things are moving. And if there are tough conversations, we have those conversations. So, if I were your advisor, knowing the very little I know now, I would say, okay, I need a calendar of your events for the 90 days. And over that time, there should be confirmation of your business diligence is done, the accounting is done, you're getting your final reports, your legal are done. You get a first draft of a purchase agreement, the first turn of comments. So even though it may be 90 days start to finish, you should hold them accountable with milestones along the way to ensure that they're acting in good faith and not kicking unreasonable tires. And again, if it's a strategic kind of buyer, an advisor will also advise the there's this tricky balance of what a strategic needs to know, but is also the secret sauce of the business, whether it's product level margins or how you produce things or whatever that know-how is. And we make sure in our processes that enough good faith has been demonstrated and that they're spending their dollars and money to make sure that, you know, they're earning the additional information, and the staging information is pretty critical in some of those competitive transactions.
Yeah.
You know, and if I just might add, you know, hopefully you have several offers, and a well-run process will yield several offers. And before you sign with any one buyer, obviously among the many questions that should be asked will be, how long do you expect to take for due diligence? So that can be assessed before you sign up and actually begin the due diligence with any one buyer. That could be accounted for.
Hey, you might just as we land here, I want to build on what's being said and what I've heard from our discussion is, you know, before you get into a strategic transaction, buy side and sell side M&A, raising capital, you know, there's 8 drivers to business, and you heard it thrown out here, like what makes you unique? That's a huge one, right? Are your customers satisfied? Well, do the net promoter score. It's easy, 1 to 10, right? Do you have recurring revenue that's predictable, right? These are the 8 drivers, by the way. Owner's trap, is the business dependent on you? Because if it is, you're going to get caught into an earnout for 2.5 years, and you're not going to like that experience. Plus, you're going to lose money. Customer concentration. Is there? Do you have key person dependence? You know, all those things work against your value to get paid twice, and it also works against your profitability today, right? So 8 drivers, right? I would say work with your growth CFO to develop these. The second thing is the habits of profitability, which are financial management. I mean, CEOs are not born to look at numbers. Most of them, you pull up a spreadsheet, you lose them, right? You got to give them visuals. Make sure that the number story makes sense. The rearview mirror, how does it flow together? What's the narrative around that? And does the flight plan forward, the financial flight plan forward, does it make sense, right? Because both for you to manage your business better today, and for these strategic transactions, when you have that, it's a different conversation. Unit economics, how do you make money, right? We talked about accrual accounting and that accounting foundation. Any delays, when people ask for financials and there's a delay, there's a problem. When people get financials and there's a glaring error, like literally net income doesn't reconcile with the balance sheet, or something on the P&L just doesn't make sense, man, you are losing confidence fast in that transaction, right? So these are the kinds of things that you can talk, you know, Steve, Abe, Jose, Randy, these are the kind of things where they can give you feedback and help you get early, get your house in order, go slow to go fast. And then when it's game time, you're ready. And I don't think you want to waste time 2 or 3 months in due diligence.
Yeah,
Okay.
no, that's totally true. So all the transactions I've been in, the key element to getting the thing done is speed. Because if you lose speed, you lose momentum, and before you know it, the deal's gone away. So with that, why don't we, that was a really spirited discussion. Thanks, guys. Thanks, Abe, from Piper, and Steve from Brighthorn for being panelists. Your insights were terrific. And we hope that this has helped to enlighten your sort of knowledge around the due diligence process. It's nothing to be afraid of, but it's something that has to be addressed, and it has to be planned for, you know, right up front. So with that, we'll bid you adieu.
All right.
Thank you, everybody.
Have a great afternoon or morning, depending on where you are.
Good to see you.
Bye, everyone.
Thank you.
Bye.